we can get that started. Awesome. Without much further ado, it's my privilege to introduce today's guest speaker, Jack Cohen. He worked 33 years in the Internal Revenue Agency, and he's been responsible for some of the largest corporate audits in the nation. So he's very experienced. Tell us what to do, what not to do. He's also the recipient of the Bernard Award in 2006. He's a licensed CPA in multiple states, also a licensed real estate broker in multiple states. And he's got some specialty areas in business formation and registered agent services. So right up our alley for our community and what we do. So Jack, I'll turn it over to you.
Thank you. Can everybody hear me okay?
We can. Thank you.
Okay.
Yes, sir.
So I'm looking at that picture and I'm thinking that picture of me must have been taken a number of years ago. I haven't looked that good in a long time, ladies and gentlemen. That's all I can tell you, seriously. And so, but thanks. Perhaps one day I'll update it. So first, let me say, of all the things I do in my practice, this is probably the most fun thing. When I work for the IRS, I would often, talk to groups of people and give seminars and teach stuff, and definitely a lot more fun than doing tax returns. I can tell you that. And one of the things I like talking about the most is real estate because not only have I've been a broker for many years, but I've actually owned a lot of real estate, believe it or not. And so if I wasn't doing CPA work, I would be doing full-time real estate. That's all I can tell you. So I'd asked for a number of different topics that we could talk about. And I am open to talking about any topic that you guys want to talk about. But if you wanted to, I could start the ball rolling by talking about things that apply to real estate and things that I've seen of late. By the way, for whatever it's worth, being a CPA is not an easy job. As I tell people when I recruit employees, if you want a job that you have to put a lot of hours in, and it's really frustrating, and we don't pay you a lot, you want to be an accountant. That's all I can say. And so definitely not easy finding people to work. So let's talk about real estate and some of the things that I've seen. I would say the biggest thing in recent years, I would say, has to do with cost segregation. And I don't know if everybody's familiar with that concept. Cost segregation's been around a really long time. It's been around so long that when I worked for the IRS, Campbell's Soup was one of my audits, and they did a cost segregation study on one of their plants, and it has to be 25 years ago. So it's an old concept that seems to have kind of revived itself in recent years. And basically, even though maybe at the time that they started to use cost seg studies, it was intended more for large commercial properties, people have used it even these days on residential rental properties. And if a lot of this stuff you already know, I apologize, but maybe some of you don't. And the basic concept of cost segregation, traditionally when you own real estate property, when you own rental property, you break it down between land and building. And land is never depreciable, and building is. And the IRS has basically standard lives for real estate. If it's residential rental, it's 27.5 years. If it's commercial, it's 39 years. And what cost segregation does, the concept is that an engineering company would go in and they would break the building down into smaller components. And the smaller components had shorter tax lives than the building. The building, remember I said if it was residential rental, it was 27.5 years. But a stupid example would be, they say, well, we'll break it down and we'll value the kitchen cabinets separately. And maybe kitchen cabinets have a life of 5 or 7 years. So basically what they do is they take this big building, or in case of a rental property, it may not be that big, and they break it down into smaller components, which you can write off, you can depreciate over a shorter period of time. And it basically is a timing difference, and timing in accounting is good, so that you get more depreciation in the earlier years and less depreciation of the in the later years. But again, timing is good. And so we've seen a lot of clients want to pay for these cost segregation studies. Now, everybody with me so far on the big picture concept as to how it works. Now, here's the practical part of it, though. And this is where the companies that do the cost seg studies really do not kind of really fully disclose everything. And most of you, some of this I'm sure you already know. By its nature, rental property, the default tax status on rental property is that it's passive in nature. So unless you're considered a full-time real estate person, any rental losses are passive losses. Passive losses for most people are limited. Limited meaning that you may not be able to claim it in the current year, but that it does carry over into future years. So the issue with cost seg is that, say you had a rental property and you just broke it in the land and building, and you had a $10,000 loss for tax purposes. Got it? But because it's passive and you don't qualify as a full-time real estate person, well, you can't claim the 10,000. You get to carry it over. Well, then you do a cost seg study, and they come up with more depreciation. And so now instead of your loss being $10,000, it's $100,000, which sounds great. Except if you couldn't claim the 10, you can't claim the 100. So in that example, even though the concept is good that you can get more depreciation, it's still not actually helping you on that year's tax return. So I think you have to, when you want to consider cost seg studies, you got to factor that in. How much more is it going to help? How much more depreciation will it generate? And will you actually be able to claim the greater loss? Okay. Any questions on cost segs? Because I know some of you, I'm sure some of you have either read
Hey,
about
Jack.
or done this. Yeah.
Hey, this is Ritarcia. So some of the questions that were sent in advance, I'll give you a couple and they probably all tie together. So 1031 exchanges, people were interested in asking about,
Yep.
as well as noting expenses for work done by contractors for
Okay.
home improvement on their tax return.
Got it.
We had questions about, which you've already talked on a little bit, but better understanding leveraging long-term rentals as well as short-term and midterm for deductions. And
Okay.
I'll give you those couple of ones. And then after that, if we still have time, I'll touch on a couple other ones.
Well, the good news is I tend to talk fast, so we can probably get through a lot of these. How's that? If I was billing you for my time, I would talk much, much slower. So you're calling me about your form 1040. Okay. So let's talk about 1031s. Again, I'm sure you probably know a lot about them. Incredibly popular. And this is going to sound crazy, but when it comes to stuff like real estate, the object is to kick the can down the road until you die. Why would that be? Okay. So what happens on a 1031 exchange, and by the way, it only applies to real estate. Years ago, that wasn't the case. But since the tax law changes in 2018, 1031's only real estate. And whether you own it individually or even as part of an investment, you would still qualify. And basically all you're doing is saying, when you sell that property, instead of paying tax on the gain, whatever the gain would be, you end up reducing the basis on the target property, the property that you bought. So if your gain was going to be 100,000 and you paid 500,000 for a new building, well, you don't depreciate 500,000. You have to reduce it by the gain that you haven't reported. And so basically you're deferring the gain by reducing the cost basis of the new property. It's a no-brainer in most cases. Now, sometimes I'll tell people, before you decide you want to do it, maybe you should consider where you're at tax-wise. If you were like in a really low tax bracket, maybe paying the tax is a better move, to be honest with you. It depends. But the truth is the concept of 1031s is really solid. And why do I say you keep kicking the can down the road until you die? Dying is not a great tax strategy, by the way. I should tell you that. So what happens is, say you 1031 into another property, and now that property gets sold. Well, you can 1031 that too. And what happens is, when you pass away, if you have assets like real estate, and you pass the real estate on to your beneficiaries, they get what's known as a stepped up basis for tax purposes. And what that means is, let's just say, because you've done all these 1031s, the property that you have when you die has a very low cost basis. Maybe it's 100,000, for example, but it's a property that's worth $2 million. You pass away and you leave as an inheritance to one of your beneficiaries this $2 million property. For income tax purposes, your tax basis is $2 million. So effectively, if you inherited a property,
We were moving. And we were like checking all this like
I think someone needs to mute out. Yeah.
That's kind of
Yep.
I woke up for some reason and I was still sleeping.
that's
Well,
weird.
If you were
And I tried to
sleeping, I
keep
understand.
the-
I get it.
Hold on, one,
I was
one
sleeping
second. I'm
too.
sorry.
and
It's
it's so
okay.
heavy that I couldn't
Hey,
get out.
Christian,
Wow.
can you mute
And then next
Evan?
thing you know, I glance up
Ari
and
got kicked out.
I'm at
Can
this
you mute
house.
Evan Berg as a host? There you go. Thank you. Sorry.
Okay,
Thank you, Jack.
No worries. No offense taken. So basically, you have this property with $100,000 tax basis. You die, it's worth $2 million. It gets your kids inherit the property. Their tax basis is $2 million. So if they sold the property right after you died, guess what? No tax. It's a pretty good deal. Except you're dead, that's a problem. But rest assured, after you die, you know your children will pay no tax if they sell that property. Okay? Any questions on 1031s? It's pretty simple. You're just deferring the gain into another property, but you got to buy another property. And I believe you have 45 days to identify the new, from the time you close on the sale, you have 45 days to identify the new property and 6 months to close. Now, let's just say you were selling, and we see this a lot with people from California that have bought properties years ago and they rented them for years and now they're worth millions. Make believe you say you're older now and you really didn't want to buy another rent. You don't want to pay the tax and you really don't want another rental property because it's a pain in the ass to manage. And here you are, you're like in your 60s. They have companies out there where you could buy a fee simple interest of a big complex. So let's just say it was a 500 unit apartment building and you wanted to buy into that. For example, you could buy 10% of that. That would qualify as a target when the 1031 exchange for the property that you sold. So there is a way to do the 1031 and still not be burdened by having to manage a rental property, if that makes any sense. Okay. Any questions on 1031s? Don't raise your hands all at the same time. Okay. Let's talk about, let's see something here.
Jack, they had a follow-on question. Sorry for your
Sure.
1031.
Sure.
Someone asked if leftover depreciation from either normal or bonus excess gets rolled over if there's not enough income to utilize it all.
I'm not sure the question. Well, again, when you're doing the 1031, there is no gain. As long as you invest all of the money from the sale, it doesn't matter about the depreciation. The entire gain is deferred. There is no taxable income. Now, I have seen situations where, and one other thing, it doesn't have to be one property for one property either. We've seen it. Say you sold a $10 million property in California. Well, you don't have to find another $10 million property. You can find 5 other properties that would still qualify as well. So it doesn't have to be one for one. And there have been situations where they couldn't reinvest all the money. That's not the end of the world either. You then just have to pay tax on the cash you walked away with. So if you invest in 90% of it in another property and walked away with 10%, yeah, you would have to pay tax on the 10, but not the 90. So it doesn't have to be all or nothing, if that makes any sense. What do you think? You think that answers the question on depreciation? It doesn't really factor in, because if it's a 1031, then it gets deferred. If there's, again, do you have any questions? Just holler out. Another big question I get, and I think, well, you have the question is short versus mid versus long-term deductions. The big thing today is Airbnbs. And so, And the big issue here in Las Vegas, of course, and it is in many other places, is a lot of people don't like Airbnbs. And so many places, including Las Vegas, have passed laws where they really restrict you doing a property as an Airbnb. And so, but for tax purposes, they are treated differently. And here's the difference. Airbnbs, I guess the way to look at Airbnbs is because they're short-term rentals, it's treated more like a hotel, if that makes any sense, like a real business. Long-term rentals, for sure, when you have passive losses, the losses are limited, but Airbnbs are really different. And a lot of people have made a lot more money doing Airbnbs than they have doing long-term rentals. So from a financial standpoint, they've done much better. And for tax purposes, at least in the initial years, if there was a loss, you can treat an Airbnb differently, where you can claim the loss, where you couldn't claim it as a long-term rental. Now, the only caveat there is that that may work for year number one, but Airbnbs generally make way more money than long-term rentals. And so while for year one, it might make sense to treat it differently for tax purposes than a long-term rental, by the time you hit year two, it's treated similar to a regular long-term rental because you have gains, not losses. And so definitely a lot more people doing the Airbnbs in the short terms than they ever did before. Any other questions on short-term rentals? I mean, as far as deductions are concerned, the same rules apply. The issue on any rental property is an expense what I would call a period expense, or is it something that has long-term benefits and you should think about capitalizing it? And so there's no difference whether it's short-term or long-term. You just have to look at what was done. And a lot of times we'll see clients that'll, especially if it's a brand new property, say they'll have to do a large rehab project on it. And then what I'll tell them to do is, if they had a general contractor on the job, send me a copy of the contract and I'll go through it and I'll call out what I think are ordinary period expenses versus maybe things that have to be capitalized. Again, expense is better than capitalize, of course, because you want to write it off right away. Okay. Let's see what else we got on your list here. Primary residence. So everybody probably knows this. If you sell your residence, you get a break when you sell it for tax purposes. And the general rule is, you have to have lived in the house 2 out of 5 years, right? If you do, and you have a gain, the IRS and most states, by the way, will give you a $500,000 free pass. All right. Especially, again, California property is very expensive. You make the 2 out of 5 rule, okay, and you sell the property and the gain was $2 million. Well, guess what? Now the gain's only $1.5 million. However, just throwing this out, what if the gain was going to be that much money? What if instead of taking advantage of the 500,000, what if instead of that you said, what if I rented the property? And what if I rented the property, I then wanted to do a 1031 exchange, okay? So you're giving up the $500,000, but by making it a rental property, because remember, only investment properties qualify for 1031s, not your personal residence. But what if you converted your personal residence to a rental property? Then you would qualify for the 1031. And so we've had clients that did that. They said, you know what? The $500,000, while it was worth money to them, wasn't worth that much. But in my example, to give up a $500,000 and they're going to pay tax on them, say the gain was $2 million, and the government's only giving them a half to pay tax on $1.5 million, is a lot more money than the tax that they would lose on giving up the $500,000. So that's something to think about too. Is it worth it to make it a rental property to be able to take advantage of the 1031 exchanges? Any questions on that? I know I'm going fast.
No, that's perfect. Can you talk to us about what everybody wants to know, Jack? How to reduce your taxes and how donations affect your taxes.
Before we move on, it looks like Lucas had a question about the last topic.
So the first question is, how do you not pay a lot of taxes? First, you make a lot of money, and then you hire me. Come on. What? What's wrong with that answer? So there's some things that you really don't have control over. I mean, for example, like wages. I mean, or if you sell a property, I mean, and you don't want to do the 1031. So sometimes when you have someone that makes a lot of money, one of the things you could do is you try to look for things that could generate a loss, which could offset your other income. So for example, say you were in business for yourself. Well, an easy idea would be set up a pension plan for yourself, do a defined benefit plan, and get a deduction by putting money into a pension plan, or buy real estate that, you know, if you're considered full-time real estate, maybe buy real estate that generates losses. Here's what used to happen to me. I made a lot of money in real estate. So at the beginning, it showed losses. Well, by year 3 or 4, it's showing gains. Well, geez, I don't want to pay tax. What could I do? I had to buy more real estate. How do you think I ended up with so much damn real estate? Okay. I had to keep buying more properties to cover the gains from the old ones. So yes, the only thing you can do in some cases is try and find investments or do things that would generate a loss. And it is possible. But again, everybody's situation is different. But I honestly believe there's enough legitimate ways to do this. You don't actually have to kind of do anything illegal or anything like that. But for example, a great example would be go back to the cost seg. If you bought a large property, say you paid $2 million for a piece of real estate and did a cost seg, I guess what? I wouldn't be shocked if I can come up with a $1 million loss. How's that? So that's the kind of stuff you do. So as Steve Martin said, how do you make $1 million and not pay any tax? First, you make $1 million. Okay. Come on. That was funny. Okay. So.
No, they're laughing, Jack. We're just all muted.
Okay. I see them smiling. That's okay. And, you know, I said real estate was my second career. Stand-up comedy would be my third career. How's that? Okay.
Tying back to your questions earlier with the 1031, can
Okay.
you tie in or talk about the military exclusion, the 2 out of 5, 5 out of 15? I know it changes
Right,
based on how long.
When you've been in the military, there's other rules that would give you greater latitude than having to make the 2 out of 5. I think they're willing to go back and count earlier years. There's some benefits that, you know, when you're military, they'll give you, but those were the general rules, the 2 out of 5. Yes. Listen, I know people who would buy a house, live there to 2 years, sell it at a gain, go buy another house. And that's what they did. And effectively they sold the houses and had gains, and they didn't have to pay tax on them. Now you can only do that, I think, once every couple of years. So you couldn't do this. Yeah. It would not be possible to do this like every year, let's just say. So, but yeah, that's still a rule. Let's see something. Hang on. Talked about donations affecting taxes. Well, turns out that when you contribute things like property, you actually get a deduction for the fair market value of the property. So over the years, there have been many tax strategies, I'm being kind, strategies to help people get large contributions deductions. You can research this. One had to do with contribution of easements. Does everybody know what an easement is on property? An easement says you own the property, but perhaps someone else has an easement where they could use it. A great example maybe would be like a shared driveway, maybe. That would be a dumb example. But so what would happen is, say you own this big piece of property with a lot of ground, and behind your property is maybe even a state park or something like that. What you do is you can contribute the easement on the property. So you own the building, but there's this big piece of ground behind you. and you can split that off into a separate piece of property and you donate the easement, but it's a restricted easement, meaning that nobody can build on it. And you donate that to a charity and you can get a contribution for the fair market value of the easement. But guess what? Nobody's ever going to build on the property. So you still have your house and you still have this big piece of ground behind you, but now you've gotten this huge tax deduction for the value of the easement. Been around forever.
Can you say what that's called again?
It's
Something
a
of easement?
contribution of it's a contribution of an easement. EASEMENT.
Awesome. For those of you who are on here, that was just solid gold right there, that nugget. I've been in a lot of different webinars, a lot of different tax stuff, and I don't think anyone has ever offered that.
There you go. There you
That's
go.
huge.
Desperate
What's
times
your
call
fee,
for
Jack?
desperate measures. Yeah, no, you can research it. It's been around forever. It's called a charitable it's a charitable easement contribution.
Gold, Jack, gold. Thank you.
Okay.
Is that the same thing like when people donate their cars?
Right, you can, now donating cars is a separate issue because the IRS toughened up on that one. Nowadays, if you donate your car, you only get a contribution for whatever the charity sold the car for. So you can't take your 19, your 2002 Rambler Hornet and contribute it and say it's worth $10,000. Okay, so if you contribute a car, the contribution is limited to whatever they sell the car for. But here's the other thing in the bigger picture. When they changed the tax laws in 2018, there's so many people who used to itemize their deduction, but don't itemize no more. And this is not a political statement. I'm just saying who was the president back then. Okay, it was Donald. Okay, and what they did is for example, they limited your itemized deductions on taxes to 10,000. So if you lived in California and you paid $100,000 a year in income taxes, you only get 10 grand. And they eliminated just about every other miscellaneous deduction. There's no employee business expenses anymore. Mortgage interest on your personal residence is limited to $750,000 in debt. And then they raised the standard deduction. So there have been so many people that used to itemize their deduction that now take the standard deduction because you can't take any of these itemized deductions anymore. So, but if it was a big contribution, like my example, say you donated like $2 million worth of land, obviously that would be a different story. And one other deduction that's still around, gambling losses. So if you win a lot of, I see Robert's laughing. Robert, have you won a lot of money lately, my friend? So if you win a lot of money at the casino, you can claim losses equal to the winnings, but as an itemized deduction. So listen to this. I could write volumes of books about stories about my clients and stuff that happens. We had one client in 2022. The wife, she had a minor gambling problem, just minor. So, when you go win at the casino, I think it's, if you win up, I think it's $1,200 on a $2 bet, they give you a W2G. So that's not all your winnings or losses. That's just your jackpots. She had like $2.5 million in W2Gs. I couldn't. Now, you'll ask me, did she actually win money? No, she did not. She probably lost about $700,000 or $800,000. But anyway, for federal tax purposes, you can take gambling losses. And by the way, I live in Las Vegas. Gambling is not a good investment strategy. Take my word for this. The only way I know you could win if you went one time, and never went back again. That's it. So real estate is a much better investment strategy than gaming. All right, back to the list. Real estate professional status. Always get questions on this. Because remember I said you can't claim losses on real estate, passive losses, if you're not a full-time real estate professional. Well, what qualifies as a full-time real estate professional? So let's start out and say, and people often misunderstand this, having a real estate license has nothing to do with you being able to claim losses. Having a real estate license means that you can sell property and get commissions, and that's great. But the real estate losses from the properties you hold is totally separate. In order to claim those, you have to be considered full-time real estate. And the first rule is you have to put in at least 750 hours a year. Now, keep in mind, you can put whatever you want on a tax return. The rules I'm telling you or giving you are only if the IRS audits you, that's what you'd have to prove to them, that you put in 750 hours a year. And you should know I've actually represented clients on IRS audits and won that issue. Why? Because I'm really good. Now, 750 hours a year. Robert,
And so humble. You're so humble.
well, it's absolutely, modesty is one of my strong points. That's right. I probably represent more clients on audits than most revenue agents have in their inventory. I don't want to show you what my office looks like. You would be depressed. But so so it's the 750 hour rule. Now, think about it. There's only so many hours in a year. So not that it's impossible, but if you had a full-time job, that's probably like a couple thousand hours a year. You'd have a much more difficult time to prove the 750 if you worked a full-time job. It would be tough. And I didn't say impossible, but difficult. So a lot of times, hypothetically, of course, since you are recording this, hypothetically, come on, that was funny. Hypothetically, sometimes what married couples will do is when the husband has a full-time job, he'll put the wife down as the full-time real estate professional. Since she doesn't have a job outside the home, it's a lot easier to prove out the hours. Now, the other interesting point here too is that most IRS employees, agents, they've never owned real estate. They have no idea how much time it takes to manage rental property. I know because I did it for years. And quite frankly, 750 hours is a drop in the bucket. If you had a decent number of rental properties, I'm telling you, I was always busy. If it wasn't tenants moving in and out or fixing the properties, and I used to do the rehabs myself, which would have counted in my favor too. But I mean, it takes a lot of time and effort. It's just, when you see these reality shows on TV, it makes it seem like mailbox money. Nothing could be further from the truth. And so, but that's basically the standard. You have to put 750 hours in. And on audit, you'd have to prove out the hours. Now, you can go back and reconstruct your records. Now, in the best case scenario, nobody does this, but it would be nice if everybody had a calendar that they use, say you had an Outlook calendar, and you just happen to put down on a real-time basis the time that you spent. You had to go visit the property. You had to go show the property. You had to go see a contractor there. You had to go to the bank. You had to go to the mailbox. You had to go to Home Depot to buy stuff. So what I'm saying is, and I realized most people are not going to do this, but if you did that and you got audited, that would certainly count in your favor. And there's no question being full-time is an advantage. There's no question.
Okay, so I guess that answers the question in the comments because someone had, if they do construction or improvements on the house, does that go toward RE professional status? And you answered it so perfect. Thank you, Jack.
Yes, if you did it, but now if you hired a contractor, the time that you would put in would be, I had to visit the house to go oversee the contractor to make sure that they were doing the job right. So obviously you put in less time that way, but if you were actually doing the improvements as I was, yeah, I would have, trust me, I would have easily made the 750. But then again, as I said earlier, my problem was I started to make money with them. Go figure. So that ruined that. No more losses for Jack. Just saying. So, all right.
Jack,
yes.
we actually have a question applicable to this. There's a member in the chat. His wife is going for RE status, but his CPA is saying that it's not valid because they live overseas.
I would argue the problem there they would have, in my opinion, now I always play devil's advocate. I don't know that there's anything that says that they can't do it. What I would say is, how the hell are they gonna make the 750 hours if the properties are in the United States and they live in a foreign country? How would they possibly put the time in? How could they do that?
The spouse is remotely being the manager for the properties.
But
It's
what
not
if
the
that-
active duty member.
That's fine, but what does that, what does that look like being the manager? I mean, I don't know. I'm just
I don't
saying.
know.
I mean, I'm assuming she doesn't pick up the rent in person. That's a joke. Okay.
Well,
We-
I can argue with that and saying that, for instance, you're meeting the contractors, you
Yeah.
are deciding who's gonna do what. Your
Yes.
hire is gonna do the walkthrough. You are, managing your time and all the software, making sure the calendars are booked.
There's a
Nothing
lot,
gets.
it's a lot. No, it is. I agree with you. It's more hours than you think. The problem is most people actually never track it because they don't care. Okay. But it is a lot of hours. What about this one? Wait, you say you want more for your money. What if you were located? Robert, you're my guy. That's all I can tell you. When I go do stand up, you're sitting in the
He
front
is your
row.
target audience. There you go.
He's my shill out there. You'll be saying, that Jack, what a smart son of a bitch. What a funny son of a bitch he is. I'm telling you. But what if you were located, what if you lived in one city and the property was located in another city?
Mhm.
What about your travel time to go there? Oh yeah, Jerry.
Yeah.
That was a Seinfeld reference. That's right. So I would count that time in too. Exactly.
So going back to that question, Jack, can somebody living overseas that's managing properties from here could count that as a real estate investor hours?
If you had a property manager who managed it, remember, it comes to, no, repeat the question then.
So the question is, I self-manage, right?
Yeah.
I hire the contractors. I'm managing everything from the
Yes.
distance, right? So it's the same case of Zachary, I think was the question. The wife that was doing.
would
So
still-
we do
any-
everything from over here. So would that count?
Yeah, yes. If it's based on the actual time that you put in. And even though you're not
Yeah.
in the US, I know it still takes a lot of time. It does. Now, whether you make the 750 or not
Yeah.
is another story, but I know it takes time. It does. So I
Now,
would
what
be
would
more.
be for you? Let's say I'm coming.
Go
I'm
ahead.
sorry. Go ahead. Sorry.
No, go ahead. You go.
What would help you in case that you were representing me and I'm in an audit? What do you want to see in my books to say, hey, this is how I meet the 750 hours? So in a spreadsheet,
I would give you a blank calendar and I would tell
Mhm.
you to fill in on that calendar everything that you did. So you can actually reconstruct it. And how you could reconstruct it, you can go back to your telephone bills. You can go back to your emails. I mean, I know it sounds crazy and it sounds like a lot of work, but if it was an audit and we were desperate, that's exactly what I would have you do. And that's what I did on other audits
I see.
where I had someone, they never kept track of this, but I had someone go back and reconstruct it. We won the case. I hate losing. I really do.
Okay.
So as
You don't want to
an
get audited. You don't want to get audited. No,
No, thank you, Jack.
you're very
as
welcome.
as an investor, when you're, let's say you don't necessarily, well, I mean, I don't have my house, but looking for another property,
Great
would
question.
the time count for something as simple as underwriting throughout the day?
Or what about, actually, you raised a bigger question. What about the time it takes for you to find the property?
Right. So all that counts.
With one caveat. You have to, in my opinion at least, you have to already own a property. And here's why I say that. This is a rhetorical question. What do you think would be the trigger point for someone to actually consider themselves in business? Because most times before people go into any business, say you wanted to buy a franchise or you wanted to, what I'm saying is there's always going to be upfront expenses before you actually enter into business. Now, again, you may not get credit for that money immediately, but you will get credit for it. But going back to the real estate analogy, if you've never owned a property or you don't own any properties and you spend time looking for properties, I would consider that a pre-business expense, a pre-opening expense. And so as opposed to, I already own a rental property and now I'm looking for another rental property. I would look at those two situations differently, but that could be a lot. That happens a lot. We had a guy who got audited just as years ago, and he was pretty smart, I got to admit. And he got audited for this issue. And I don't know if he researched it ahead of time. He actually went to Europe or someplace. I mean, like it was, listen, between me and you, he went on a friggin' vacation. I'm not that stupid. Okay. But what he did is he went and looked at all these properties and he got the brochure from the property, the business card from the agent who showed, I mean, he had records up the proverbial wazoo. As guess what? We won the audit. I couldn't believe it. Even I couldn't believe that one because I knew it was all bullshit. But so what I'm saying now, and I listen, you can't go crazy over. I mean, you can't spend every day, every hour of every day trying to worry about keeping records. You do the best you can. But the truth is, if you have if you have an Outlook calendar and you have rental properties, it's probably not a bad idea to mark on the calendar different things that happen during the day in the event you ever got called on it. And again, they don't audit that many returns anymore. So it's highly likely you won't get audited. But sometimes it's just easier to do things on a real time basis than to go back and try and reconstruct them afterward. That's all. So, okay. What about using your car for your rental properties? We didn't talk about that. So unless you're taking the bus there, what about driving there? Aren't you entitled to automobile expenses? Of course you are. And I have a rule too. If you want to write off your car, and it's a really expensive car, I have to be able to drive it. I'm just saying. Just saying. Come on, that was funny. If you're writing off your Maserati, I better see this son of a gun. I better be able to drive. We had somebody come by the other day with a Porsche, a really nice one, boy. Let me tell you, that was a nice car. So yes, what about writing off your car? I'm sorry, I didn't mean to interrupt, Sherry.
No, I was just going to throw in a plug for all the questions about tracking hours. I am a real estate professional designee, if you will.
Sure.
And I found using the tool, the REPS tracker, REPS tracker.
Okay.
It's an app-based tracker as well as
I never heard that one. That's great.
as well as a desktop-based tracker. And it's really simple. And I use it every day. And you track your hours and you can log in with you can add your properties in there. So you just quickly select which property you were working on, what you were doing, and it tabulates your properties, what you were doing. It has drop-down tabs, and
That's wonderful. That's really
it's so
good.
efficient in keeping.
Is it a free app or you have to pay?
No, you have to pay, but of course that's a business expense.
Of course.
It's
And
$29.
just remember, whatever you pay me. Come on, that's a plug.
That's a
That's a deductible
Yeah.
expense too.
So
So if you need a big deduction, I'll just raise your bills. That's all.
yeah, so it takes all the pressure off of going back to recreate anything. And this is January, so this is a great time
Great time to
to
start. Exactly. That's a
start and
wonderful
go
idea.
ahead and get your books in order so you don't have anything.
If you get a chance, send me an email and give me the name of the app because I'd be interested in passing that along to some of my other clients. So.
Absolutely.
So I just thought of another topic too. Now, maybe this is a dumb topic, but I still have a little time, right? I'm okay time-wise? Keep going? Okay,
Got 10.
10. All right. So as an investor, let me pose this question. If you were going to buy a piece of real estate, and I gave you two options to how to buy it, I want you to tell me which one you think would give you a greater rate of return. So option one is you buy a house or a piece of property. Robert, don't go too far. I need you here, buddy. What if you decided you wanted to buy a property and choice A was you pay cash at $200,000. That's door number one. Or door number two, you can finance all $200,000. What would all, I know there's other issues, but just keep this example simple. What would your choice be? Pay cash or finance the whole thing?
Finance.
I have to play the Jeopardy theme song here. Dun, 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 dun. Who wants to guess? Anybody want to yell out a guess? Cash or finance the whole thing?
Finance.
Ann, you raise your hand, Ann. Okay, no. Who's up now? Go ahead.
Christian, finance.
Finance the whole thing.
Yeah.
Is that your final answer?
That's my final
You
answer.
sure you don't want to poll the audience or ask a friend? You're sure?
Some people are
There's
saying
big money
cash
involved
flow
here. You're
Yeah.
sure?
Some people are saying pay cash. So, I mean, but I would say finance it.
Finance.
You would be 100% right. It's called leverage. Let me give you an example. This is a no-brainer. If you pay, let's use an easier number because I really suck at math, so we have to use easy numbers, okay? I shouldn't really tell you that, but okay. $100,000 cash. And make believe, now you got no mortgage on the deal, right? And you make, because you have no mortgage, you make $1,000, $1,000 each month. So at the end of the year, you made $12,000, right? So you invested 100,000 and you made 12,000. Would you agree that sounds like a 12% return on your money? Everybody okay with that? What if you financed all 100,000, but because you have a mortgage, you don't make $1,000 a month? Now you only make $200 a month. So for the year you made $2,400, but you've invested $0. Don't you think that number two is a much better rate of return than number one? It is, of course. That's how Donald got rich, okay? It's called leverage. So you always want to use, when possible, other people's money, even though you're paying interest. And today you're paying even more interest because the rates are higher. But that's the goal. And what happens too, don't forget, as years go on and you start building equity up in properties, what do you want to do then? You want to get your equity out. Why? So you can buy more properties. That's why. Everybody okay with that? So you're better off financing than paying cash. Any
You've got a
questions on
follow-up
that one?
question to that one.
You did good on that. You did, let's face it, you had a 50-50 shot at this. Let's not kid ourselves, okay? You could have flipped the goddamn coin and had a shot, but you were right, to be fair. You were. Good job. Good job.
So Lucas is asking, like, well, and this might be a question for more ADPI people as well, but couldn't you just reinvest the 12,000? It's like, is there an advantage to having the 12,000 in hand to turn around and reinvest that versus the 2,400 in hand?
Well, you could, because again, all you're looking at is if I had that $12,000, okay, can I get a rate of return of more than 12? What I'm saying is you're always looking to get the greatest rate of return on your money. So yeah, if I can make more money in real estate, then why wouldn't I want to buy more real estate? I'm just saying. So yes, you're right. I'm saying that yes. And most people, if you told me you were going to get this huge rate of return on an investment, the first thing I would think of is you're probably getting scammed, because I'm telling you, I see this all the time. We had one client, this is a great point. You should always listen to me. I am right 99.99% of the time. I've been wrong twice in my life. Would you like to know what that was? Wife one, wife two. So we had this client a couple years ago who wanted to invest in some kind of a date farm or some kind of a friggin' farm in another country. And I told her, you don't want to do this. This is a mistake. She should have listened to me. She lost a lot of money. We had one client that wanted to invest in a sushi restaurant in Fort Lauderdale. Don't do it, I told her. Most restaurants never make it past 5 years. In less than a year, the restaurant was closed. She lost $1 million. So here's the moral of the story. Before, people that want to sell you stuff sometimes make it sound better than what it is. And sometimes people feel like they're pressured into making decisions. So these are the secret words to help you out. Before I make any investment, I promised my CPA that I would run it by him. And that is the end of the discussion. And I have talked people out of doing really stupid shit. Seriously. Because here's the thing. CPAs are the most trusted advisors of all because we have no skin in the game. The things that you do, I don't make money or lose money. So I'm always going to give you my best opinion, an opinion that I would take for myself, I would give to you. So what I'm saying is if, sometimes things seem too good to be true, many times they are. So you can always use me as the excuse. How's that? Okay. We got a few more minutes left. Let's see. Separation of business and personal finances. The only reason you want to keep things separate is to make life easier for yourself. That's all. Because say you're using one credit card for business and personal, and we're doing your tax return, you're going to have to go back and you're going to have to tell us which expenses are business and personal. So while it's not always possible to keep everything separate, the better job you do, the easier it's going to be for you when it comes to tax time. That's all. So, okay. That's very common, you know.
Hey Jack, there was one in I'm going to be a little selfish. There was one in the comments that I really wanted to ask.
Sure.
Are there ways to leverage paying your children to offset your active W-2 through the real estate business activities?
So that's a great question and very common in not so much in real estate, but I see this a lot where people have actually operating business. They put the kids on payroll and you do save some money, not tons of money, but some. And let me give you the example why. And I think, trying to think, last year you can pay the kid up to like 13,000 and they don't have to pay any income tax. They don't even have to file a tax return actually. So what happens though is that when you put someone on payroll, you have to pay Social Security. So you're paying Social Security, say, on the $13,000. But if you get to deduct your $13,000 salary and you're in the 37% bracket, you save 37% of 13,000 and it costs you 15 cents. So you save like 25% on 13,000. So if you have 4 kids, that's not bad. And so we see a lot of that. I'm not going to lie to you. I've never seen it on rental properties. That might be a little stretch. I mean, but certainly in real businesses, I mean, you could argue the kid came in and did filing or something, shredding or something like that. So, but I do see that a lot. So it's not going to save you tons of money, but it'll save you something.
My husband went around with his dad. He did roofing, drywall, window repair, like starting in his like
But was
8 or
your
9. So
but was your dad in business as a contractor?
my husband's I see what you're saying. It
If
would be
you're in
more
business,
toward
absolutely, yes.
okay. I
Yes.
see what you're saying.
Yeah.
I see the
That's fine.
distinction.
I'm okay with
So
that.
he's paying the kid as a contractor. He would have to pay the kid as an independent contractor, essentially.
Yeah. Or
What
put him
about paying
on
kids?
payroll. Yes.
Sorry. What about modeling? So basically taking photos of your family and then using the photos of your kids in your marketing collateral.
Yeah, that's the same theory there as if I get a magnetic advertisement and I put it on the side of my car and that makes it deductible. No.
No. Okay. How about inserting it in website or doing like mail outs with that has a business card?
But you can, but I'm telling you ahead of time though. I mean, you can claim the kids. I mean,
Mhm.
it's not usually a lot of money, but you can put the kid on payroll. That's fine. You don't have to go to those extremes. I'm just saying. But,
Okay.
but yes, of course, you can do that, of course.
All right.
But I
Yeah,
don't
just
think, but
throwing
I
stuff
think,
out.
yeah, we don't, if you had a business and you told me the kid was working for you for 13,000, he worked during the summers, let's say, and you wanted to put the kid on for 13, I wouldn't argue with you. I'd do it. It's not a big deal.
Is
All
it
right.
better to have is it better to list someone as a contractor or as an employee?
Great question. So from the person that's paying, payroll is very expensive. So generally, you're better off treating them as subcontractors. The problem is that in many cases, it's a bit of a gray area, and states like California have really come down. In California, you can't have 1099s anymore. Can't be it. I mean, not getting sued for it, but so the issue would be anytime someone works for you. That's a great question. Actually, it was, I think that was one of the outstanding ones. Anytime anybody's doing any work for you, you know what you have them do? They give you what's known as a Form W-4. And that tells you whether they're operating as a sole proprietor or a business. And based on what they put on that piece of paper, that tells you whether you have to give them a 1099 or not. But if it was a contractor to fix your home, they're not employees, they're contractors. Yeah. The bigger issue would be people that actually have operating companies and say they're paying the secretary as a contractor. No, you can't do that. They're employees. So, but that's a very topical issue, whether you're an employee or a contractor. So, okay. Let's see. And I think that question was on there about contractors for home improvements. Yeah, you want to have them give you that W-4 because that's your get out of jail card free. Because if you get audited and it turns out you were supposed to issue them a 1099 and you didn't, guess who's paying? It's going to be you. So, all right.
Jack, I think our host is gonna
Wrap up.
take over the screen again and wrap up.
Okay.
Just give us 1 second.
Cool. All right. Yeah, so that was our question and answer.
Oh, let's
we'd
go
like
back
to
one
thank-
slide. You want to
go
make
back
sure we
one
give
slide?
everybody
Oh, yeah.
contact information. Jack, are you still good with us sharing this email address with
Of
everybody?
course, absolutely. I have no life. It's okay. But I'm not going to be working Sunday because football's on. I'm just letting you know.
Heck yeah.
All right, good stuff.
Would you like my phone, the office phone number? I can give it to you.
Awesome. Yeah, if you share it here on the chat, Jack, that'd be great.
Yeah.
Jack, if you say it out loud, I'll type it in.
I'll say it out loud. You handle it. It's 702-255-2330.
Awesome.
Awesome. Yeah, so if you haven't had a chance yet to pull out your phone, take a picture of that contact information or the phone number in the group chat, and that would be a good time to do it.
A big shout out to Robert for being
Number one fan.
number one fan. There you go.
So as we wrap up, when you leave the Zoom meeting, it'll ask you to do a survey. It's a quick 2-minute, 8-question survey. We'd love to get your feedback for our future events. Let us know how we can make this better and more applicable to our audience. So upcoming activities, events that we have in 2024. We're trying to do one basically every other month. So we've got some things planned, some awesome events planned. So be on the lookout for those. I think in the sign up, it asks for your email address so we can push out this information. You can also find us on our Facebook page, ADPI. The Asia Pacific region is who we are, and it's just a bunch of people, same like-minded, same goals, same problems. So people that want to invest in real estate but have the barrier of being overseas. So people are in this group that have found solutions. So if you've got questions, if you want to get into it, you're just not sure how to do it from a distance, this is the group to be a part of. And I'll turn the time back over to Anne to finish wrapping up.
Yeah. Thanks, Christian. So the other way, so obviously we're all here together virtually, but one of the things that we really enjoy is be able to take these relationships, these connections offline. Some of us have our own local chapters, like Christian's just get everything started over at Come Humphrey. So if any of you are here in Korea or know of someone in Korea, and want to do in-person engagement, we can do that. But of course, we also now have a new opportunity to share with you all, and that is we're going to do a regional level military real estate conference. So any of you who attended ADPI Con or maybe even Bigger Pockets, you know, they do most of that stateside. Well, there's none of that here in this part of the world. So we're looking to create that opportunity. We do have it scheduled. We even have our big sponsor, Guam Visitors Bureau, who's responsible for all things tourism related here in Guam. And so they're putting in for this to make it possible for us to get together. So it is scheduled for March 29th and 30th to be hosted here in Guam. We don't have a whole lot of details yet to share with you, but I do wanted to share it today just to know that it's happening and it's coming, and that to go ahead and mark off the dates. The great thing about this event is not only is it creating an opportunity for us to gather in person in one place and space, but it's getting access to education in a way that you won't see or don't see as much stateside. So just to throw it out, some of the topics we're talking about is like 3D concrete printing technologies in the space. We're talking about how to purchase real estate in Japan, how to purchase real estate in the Philippines. Like we're trying to get those types of guest speakers here to have those types of conversations. It's going to be more breakout room style. So think of a fiesta, if you will, because I'll use that term here on Guam. And there's going to be a whole lot of different dishes. And so you'll literally start the program and then you get to pick and choose which food item that you want to put on your plate to enjoy, and then additional opportunities created to do networking and meet new people. So I think it's gonna be a really good program, and we're really excited to have the opportunity to be able to put it together and offer it to this community. So save the date.
Okay.
All right, and if you guys liked what you saw today, it takes an incredible amount of effort, incredible amount of skill and resources to put one of these events on. And so we're able to do what we do because we have a team. So you saw really just half the team today, but we have other people who are part and do things that help make this possible. So what you're seeing here is not only the team that's here today, but also where the other opportunities are. So if you or someone you know are in any of these other locations in our region, and they want to see what we do and be a part of what we have going on, I'll have them reach out to any one of us on the team, and we can help tell you more about us, what we do, why we do it, and see if there's a role for you. All right, and so in closing, I just want to first of all say, Jack, thank you so much for the comedy, for the humor. You know, I always tell people all the time, you know, when you normally think about someone who is a CPA, and especially at the level that you're at, who also served as an IRS agent doing all these investigations and having these huge wins, the one thing and then the broker real estate side, like, so that in and of itself is already like, you know, pretty high up there. And then you come in and you give your presentation and you just deliver all these jokes. It's like, it just makes it so unbelievably entertaining. So thank you for taking a subject that is normally pretty not as exciting and making it fun too. And then I also want to do a shout out to Christian. This is his first time hosting, and so incredible job, Christian. Thank you for doing it. And I'm sure I'm going to hear more about your experience being in the back trying to manage this crowd. It's always interesting. And then of course, big shout out to the rest of Team Asia Pacific, because it's without you, this isn't possible. And then for all of you who are here today, like being able to participate, we do this for you, but it wouldn't happen if you weren't here. So thank you for being here. Christian, did you have any last things that you want to say?
No, just thanks for being here, and thanks, Jack, for everything you've shared with us.
Thank you guys so much for joining us today. At this time, I am going to stop recording. Is that okay?
Yeah.
Sounds good.
And then Christian, if you could go ahead and remove or stop sharing the screen, and then that way we could see who's still here.